Listen, we had a broad discussion there. So if you think the stock market may move higher this year, a lot of bulls still out there. Your next guest says you might be out of luck. Blackstone's Joe Zidle says April may have been like a Jack Nicholson movie, as good as it gets. And he joins us now. Have we seen the top for the year, Joe?
I think we have. Welcome. Good to see you. Thank you. I think we have seen the top for the year. I think as long as trade lingers, we're going to have a very difficult time seeing any new highs in equities. And I think credit spreads have probably seen their tights for the year as well, which they saw back in April. I think our base case is that we will get a trade deal. I just don't think we're going to see it anytime soon. My guess is all of 2019, this is an issue that's going to linger. It's going to weigh on growth. It's going to weigh on corporate profits. It will weigh on sentiment.
Is the bond market in charge, or is the stock market moving the bond market? Who's leading whom?
This time, I think it's credit markets that are leading equities lower. And that's very different from what we saw at the end of 2018 when markets cratered, right? Then it was equities that took credit lower. This time we're seeing the reverse, and I think we need to pay attention to that. You know, equities are within 4 to 5% of their highs that we saw back in April, but credit spreads aren't really showing any signs of turning around. I think that sends a message. The message is economic growth here could get hit by this phase of the trade war.
So this triple B threat we talk about, or at least we hear about, because we look at essentially that one notch above junk is the biggest tranche of debt outstanding. Blackstone, to me, is one of the firms that I believe is on the cutting edge of what's going on with credit. How do you deal with this? And is it something that you can say now, based upon the expectations you have on growth, that you guys will be doing in your portfolios?
Well, there's some good news out there, and that is this is not the end of the economic expansion. It's not the end of the bull market. I think this is going to end up looking like a late cycle pause by the time this is all said and done, because I don't think the trade war is going to be a big enough issue to push the U.S., China, or the global economy into recession. Europe's in a very weak spot, and we could very well see the big three in Europe being Italy, Germany, and France all in recession in 2019. But even a European recession is not going to be enough to pull the United States into a recession. So I think the silver lining here is this is an economic expansion that's going to continue for years. And when all's said and done, this is going to look like a very ordinary pullback. Since 1960, if you look at every single calendar year since 1960, the average drawdown for the S&P 500 ends up being about 13% over the course of any given calendar year. That could very well be the case this year. But longer term, those issues in the corporate bond market, I don't think are going to be issues anytime soon, because while we might have trade as an issue and we might have corporate profits as an issue, we have a very accommodative Federal Reserve. I think rates stay low for a very long time, and they could end up steepening the yield curve by essentially reinvesting all those bonds that are going to be rolling off starting September. They could reinvest those at the short end of the curve, push low rates down while the long end stays here or maybe even goes higher.
Joe, it's a bold call. I respect it. Quick, we have 6 months left in the year, give or take. Fed rate cut, does that change your calculus at all? I'm in the camp that a Fed rate cut actually is bearish, but could that actually take the market to new highs?
It would certainly help, right? Because you think about what drives valuation, it's earnings and interest rates. So if the Fed does cut, I think that helps. That said, I don't think the Fed actually has to cut. I think this is an overreaction that we're seeing with respect to trade. I mean, we've seen this massive flight to quality with the 10-year falling to 2.2 and change. My guess is that the 10-year is hitting cyclical lows right now, and we're going to see it rebound. So we could see a yield curve steepening, which is going to be good for the economy, and it doesn't actually require the Fed to do much at all.
Does that 3-month 10-year inversion signal to you a recession? Doesn't sound like you think it does.
No, the 3-month 10-year is not the most predictive part of the
I know
curve.
the 210 is, but it's like you got to start somewhere. And Jay Powell, the Fed chairman, had referenced the 3-month versus 10-year at one point a couple of months ago. That's why we look at it.
Yeah, the trick to the 10-year to 3-month is you got to do a lot of math to make it produce a good signal. It has to invert, for instance, for 10 days in a row. Who knows why? It has to average minus 15 basis points over the course of 3 months. Who knows why? You don't find that with the 10-year versus the 2-year. In other words, the 10-2s is a cleaner signal. The bad news about the 10-year 3-month is this. Historically, when it inverts, the rest of the curve falls in a line eventually, which means the data tells us the 10s, 2s will invert, just not necessarily anytime soon.
You know, there was one thing, guys, very quickly that happened today that didn't get any attention because trade is just eating the headlines. Yep. The Trump administration effectively threatened Europe over their dealings with Iran. They said, if you deal with Iran, you're going to lose your access to the capital markets. We got Italian banks. We talked about it last night, down 20% in 30 days. Deutsche Bank down again today. Are we not worried enough, Joe, about Europe?
Well, I think Europe could end up really seeing very
$19 trillion
tough,
economy, by the way.
Yeah, very tough conditions. And Italy's already in a recession. If there's a silver lining to that, it's that they know how to handle recessions really well.
They're good at it. They do about 6 a year.
Yeah, like three since 2008. They know what they're doing. Germany and France could very quickly follow. I think it's going to push the ECB to another one of these do whatever it takes moments, right? Draghi did that in 2012. I think 2012, prior to the London Olympics, was when he gave that speech, whatever year that was. And obviously, there's going to be a new ECB chair soon, but I think the ECB is going to have to panic. And when they do, my guess is
that a buy signal? Sometimes panic can be a buy signal.
Well, you want to see
liquidity ends up
policymakers
being
panic.
fueled.
That's what I'm saying.
Rallying.
If you said if Super Mario is going to do the smash the recession turtle with a hammer, right, he's going to throw money at it.
If you have a problem that can be solved with money, then it's not a problem anymore. It's good advice. Take that one home.
Wise.
I'll tell you what.
He's like an owl with a graduation cap.
Sounds like his wife might have told him that last time.
I've used that one at home plenty of times.
Literally,
think about that
wise
3
owl.
times.
How many licks does it take to get to the center of a Tootsie Roll? Joe, thank you very much. Appreciate that. Guys, thoughts around the table. He thinks the highs for the year are in. Anybody disagree with that? Anybody agree with that?
Well, I would just say that I think it's very difficult to argue for the equity markets how anything but counter-cyclicals will be bid. And I think that's probably between now and into 2020.
What does that mean, counter-cyclical?
That means companies that are not semis, that are not going to be financials. Dan Nathan and I have sparred over the last 6 months about banks. He's largely been right. I don't think financials are the home of the next blow-up, but I do think banks cannot outperform in an environment like we have.
I love it. The one time you say he's right, he's not here.
Yeah, of course. Why would I say that when he's here?
You know, I tend to agree with what Joe's talking about in terms of have we seen the highs. I still think you got to understand, like Mike Wilson's pointing out all the time to us, this is a rolling bear market. So it doesn't mean like everything's going down and you can't buy anything. I think there are opportunities that still present themselves every single day. It's just a little bit more difficult because a day like today was almost impossible, right? You're down 400 points and it just suddenly started to melt back up and then we're only finishing down 200 points. The semis were strong. You look at China, that was strong. The FXI. Look at Brazil. Look at the FXI. Both
EM traded okay.
Yeah, trading in
well.
positive territory. Didn't really make sense, though, based upon what we were seeing in the market. So it just makes it that much more difficult.
It makes sense, Steve Grasso. People are saying maybe the worst is over.
I believe that. I don't think the positioning is as bad as it was in December. I think there's a risk to the upside. Once these trade conversations start to have a better tone, and as long as the Fed stays soft, I think that we're good, and I don't think that the highs are in for the year. I do think we can climb back to those levels.
Quickly, one thing I've been saying for a while is you'll know it's over to the downside when the market has a big down day, rallies late, still closes lower, and the VIX closes unchanged. You didn't get that today, but I'll tell you, it was close. So just throwing that out there.
Tomorrow's an important day. We'll see if there's
Every day is important, Brian.
Tomorrow's more important than today.